I think there's going to be a large dichotomy, even more than today. Either housing is affordable for as many people as possible, or housing is an outperforming investment and wealth creation vehicle for as many people as possible. So what happens when these things collide? You have political unrest. We're going to flip the chessboard upside down. Let's just burn it all down and start over.
Welcome to the Purpose-Driven Capital Podcast, where we help you align your money with your mission and maximize your impact. Here's your host, Matt Johns.
Some commercial buildings will never come back, but it's not because the economy failed, it's because behavior has changed. Over the last 5 years since COVID, commercial real estate absorbed a shock unlike anything in modern history. Remote work, rising rates, refinancing cliffs, and a fundamental repricing of risk. And the effects go far beyond office towers, into housing, lending, even entire cities. Kevin Shtofman has operated in finance and real estate through the great financial crisis in 2008 to the COVID shutdown just a couple years ago, and now this new norm in real estate. We discussed what changed, where capital is moving next, and then how to think about risk in a world that no longer behaves the way it used to. Welcome to my conversation with Kevin Shtofman. Discipline is not something that's foreign to you by any means. I mean, you're an Ironman triathlete.
I did Ironman Texas in 2013. Then I did Ironman Miami in 2014. And then we got engaged. And my wife said, "This is a really neat habit you have going on there."
A habit.
But could you not do that for a little bit? When you do a lot of this prep with other people, you have other accountability partners, you have other people on the journey with you, it really creates like this sense of community. So.
It's got to be nice to be driven just by yourself in one particular direction for whatever that is that you're trying to achieve. You know, best time just to finish whatever. For me, it'd be just to finish one part of the race, let alone the entire thing. But, you know, to finish the race, to get the best time, to whatever it is, to be self-motivated that whole path.
I think it's kind of a character trait that like a lot of successful people have. Like, I'm not going to say it's causation, it's more just correlation, but there's definitely a clear correlation between people who are just, they have some sort of competitive physical spirit and the discipline that's required to go with that. And a lot of that then translates into work, not just work life. Yeah.
Now, I do want to talk about your profession because your focus in recent years has been on commercial real estate. And you kind of came into it expecting to go back into maybe some consulting or something like that, but you really found that you loved this world. And especially the tech side, the PropTech side of all of this. But you were there from the time, I think in 2019 and beyond, and that was right when COVID hit. And I'm just trying to think, how much did your industry change in the time that you started with this particular company, growing it from a smaller startup into something far more significant down the road? What did you see in that time as COVID took place, as commercial real estate went through the up and the down, the major down that it went through as everybody started working from home? What did you see in that time?
Well, going through cycles will humble you, for
Yes.
sure. I remember thinking this was actually the week before the border basically got shut down. This is early March 2020. We had just gone through this 6-month run of signing up a bunch of enterprise clients. We were growing rapidly. And we were at the hotel bar at the St. Regis in San Francisco. And I was joking with some of my colleagues, like, why does everyone say startups are so hard? Like, startups are easy. You just have to like go sell and then, grow revenue and like everything works out. And then a week later, like no one is getting on an airplane. The budgets are frozen. Like nothing is happening. And we did a couple small deals, but we didn't do another enterprise deal for 7 months.
7 months.
After that week. So all I could think about is, man, I jinxed it so bad. Like how bad must it be for us? And then I just looked around and it was, it wasn't just us. Carnage everywhere. But I also, another lesson I learned from that was everyone that had like basically predicted that life was over in Armageddon, and it was just another market cycle.
Well, why were they saying it was over and it was Armageddon at that time?
People thought, okay, no one's going back to an office. RTO's never going to happen. It's a new normal. We're all going to live on Zoom, and we're going to do happy hours on Zoom, and somehow that's going to like fulfill this hole we now have in our social heart. And we're all just going to be content to like, put a spray bottle to our delivery food and everything's going to be fine. And oh, by the way, no one's going to go shop at a retail store anymore because now Amazon can deliver everything that we could ever desire, and it can do it with Prime in 48 hours. Therefore, these two formerly core verticals of real estate are now dead. We're calling it, here's the date, dead on arrival. And multifamily is the safest asset class. So please put all of your money there. And for 12 months, these prognosticators were correct.
Mm-hmm.
And then mid 2022 hits, interest rates go up. ChatGPT gets introduced to the world. All of a sudden, every multifamily investor that put floating rate debt on their property is now upside down. Their collateral that was backing the debt is lower in value. Previously marked dead asset class retail is now on the rise because people have been starved for experiences because they've been trapped in their homes for a year and a half. And now they don't really want to buy a lot more stuff. They've been buying stuff for a year. Now they want to see people and they want unique experiences. Now experiential retail is on the rise. And people don't want to go to a state office building, but they do want to be with other people. So now co-working is really big. And wouldn't it be great if we could go to some interesting placemaking on the bottom floor? So now mixed use is back. And now here we are today in 2026. Industrial real estate's being rethought. What used to be like junkyard storage has been rebranded industrial outdoor storage, and it's like trading for high multiples. What I've learned through all of this is everything's a roller coaster. Everything goes up, everything goes down. So I think it comes down to placemaking. Like I've seen all the laughable, RTO policies introduced by investment banks and tech companies trying to force their people back. And there's always going to be a push-pull between management and worker bee. But the companies that have done it the right way have said, look, with AI, we can now invest in our best people and worry about retention and not like laying off a bunch of people. Instead, we're going to invest in our top players so they stay and we don't have to spend all the money to go out and interview and hire and train new people. We're going to invest in our best people now. And we're going to do that by giving them, amazing places to come and collaborate when they need to collaborate. Now that means they might only be coming 2 or 3 days a week to the office. We can't really sublease the office for the other 3 or 4 days when most of our employees aren't there. But we can now better space plan. So if we had built a campus or we had leased suites that were designed for 500 people, well, now we can grow in this market and we can technically have 800 people at a time and we don't need any more space because everything else is redesigned for collaboration. And when they need privacy, there's little areas of privacy, and most of that privacy stuff, they're going to do it from home anyway because that's more convenient for them. But when they come visit, they can be entertained, they can be wined and dined, they can get a lot of work done, and they're excited to come to these environments. So the buildings that lose are the 1980s era office buildings that haven't been updated, and the cost to update them will actually be more expensive than just demoing the thing and rethinking the entire building ground up. Now, there's some retrofits where the economics will pencil and they'll work. But in a lot of cases, some of these buildings are just, they're dead and they have to go away. But what comes back up in their wake ends up looking a lot more mixed use. So it'll be a building that has some office space. Maybe it has some co-working. Maybe it has some retail. Maybe it even has apartment or hotel for people that are coming in to visit from other places or that just want convenience and want to live near where they work because they're young, but they want mobility to move. And like that's where what's happening to a lot of these buildings. And I'm the believer that because these buildings are still getting built and people are still coming in a couple days a week, it doesn't matter whether they come in Monday through Friday or they come in 2 days a week. They're still having to pay the same amount of dollars per square foot to have exclusivity of that space for their people.
Sure.
So like although they'll have less space, it doesn't really affect rates. It affects amount of space that is rented.
I'm really curious to get your thoughts on the housing side of things, because what we've seen, I mean, since post-COVID, we've seen this huge shift in home ownership and who's the haves and have-nots. But now it's the haves are those who bought before 2022, and the have-nots are those who did not buy as prudently as maybe they would have otherwise before that time. So you've got this really, really strange dynamic now of home ownership being like the cornerstone of wealth, right? So I'm curious to get your take on that, because we're talking about affordable housing, and that's one thing because that's rentership as opposed to ownership. And what is this going to look like in the future, just in your eyes, from a real estate perspective?
I think there's going to be a large dichotomy, even more than today, between those who say, I want to build wealth in my home, therefore I'm willing to sacrifice mobility. I'm going to stay where I am and my family's here, therefore I'm staying here because this is my home and I'm building wealth here. And yes, I might have to say no to a job that requires relocation, or I may not be able to pick up and move, but I have this wealth building vehicle. And then there will be some people who say, I don't want to be forced to be in one place. I want some freedom of movement. And not only that, I want the flexibility to do it whenever I need to. Therefore, I'm willing to pay the same amount or maybe a little more in my living expenses without that wealth building vehicle, so that I have the freedom to move whenever I want until I find that perfect opportunity where I am going to then set roots. And because you have these two different camps on that side, now you have two camps on this side. And camp up here is housing is an investment. It is the American dream. It is how I build wealth. I need this asset to continue to go up in value. And then you have this other camp down here that says, well, life, liberty, and the pursuit of happiness, like property, shelter is part of that. Shelter needs to be affordable. Well, these two philosophies are at odds with one another. Either housing is affordable for as many people as possible, or housing is an outperforming investment and wealth creation vehicle for as many people as possible. So what happens when these things collide? You have political unrest, and we are starting to see that right now. And I think it is only going to exacerbate further. I mean, you see what's happening politically with our leaders, right? Trump was populist on the right, Mamdani populist on the left, and both of them are more popular than ever because people who have not gotten the long end of the stick are saying, well, we played by the rules and the rules aren't working, so we're not just going to work harder and innovate. We're going to flip the chessboard upside down. Let's just burn it all down and start over.
I guess we'll have to see on that one, because the unrest is clearly there. But I'm looking back at all this too, and I mean, COVID really did shake things up in a way that, from a real estate perspective, that certainly was not expected. Nobody could have, but I think there were signs that might have been there that led to what was going to be inevitable, and then COVID ended up being an accelerator. Work from home being an example, right? But so let's just say we know where we are now. 10 years from now, 2036, where do you see all of this kind of real estate morphing? Is there a certain direction you see things going? Obviously, with PropTech, you're looking at that from a sort of unique angle there. But I figure from a data perspective, from whatever it is, it's real estate. It's a property. It's a place where things happen, right? So it's not the technology that's there, but maybe the technology is driving activity there. I don't know. What are you seeing change over the next 10 years, just in the trends that you are seeing from your seat?
I think the biggest demographic group, the baby boomers, are now getting to the point where even their younger children, younger millennials. Now, I was born January of '81, so I'll call myself like the oldest millennial. I don't think I'm quite Gen X, but like so people 10 years younger than me now, they've already been out of college for a while. So that generation that had children they're now all empty nesting, and they probably don't need that big home anymore. So they're not, but they're also not old enough to where they need continuous medical care or close proximity to critical facilities. And so there's this demographic band that is going to be moving to what I would call like luxury living active communities. So a lot of senior living development happened a decade ago. It was a little too early. It didn't make the money I think a lot of people thought it would. And that asset class got soured on. Like if I had money, that's where I'd be putting it right now, is like senior living, but for folks with means, because they're now selling that asset that's been building over time, that wealth creation vehicle, that home. They no longer need it. So either that asset is being passed to the kids, so you have a massive wealth transfer moment to a younger generation that could collateralize that asset and invest in other things, or that asset is being sold in the open market. They're downsizing into in a community, and now they have this additional capital to live their lifestyle. So what entertainment and experiential concepts are going to serve that community that now is retiring and has more time on its hands and has capital, but is still young enough to where this isn't about healthcare, this is about life care, right? That's where I think the next 10 years of real estate is going to be really big. And then the other side of that, I think we'll see some sort of data center bubble pops. It's the amount of money that's being invested in data centers, and they're not exactly making friends in the communities where they're being built. And so I think you're going to see a lot of pushback on those buildings.
Mm-hmm. And that's probably going to happen sooner rather than later, I would imagine.
Yeah, next 24 to 36 months. I actually think it will be a big election topic in 28, is like what type of legislation is being passed to quote unquote protect residents from the problematic data centers that are popping up everywhere, and they're gross and they're not good for neighborhood values and all that stuff.
So on the one hand, you've got AI and this driving technology that is being pushed by anyone and everyone with a desire for progress, right? Financial, technical, whatever kind of progress you're looking for. And then on the other hand, you've got people who are trying to preserve their home, preserve their land, preserve the property of which they own. And they don't want to see it corrupted by this other thing that must grow. So that's a really interesting tension that you just brought to light. That's probably a whole discussion in its own right too. Yes. But I don't know. Do you sit on the data center side of things very often? Is that something you're into?
So we have a couple clients that develop data centers, and data centers are following the same path that other industrial warehouses and logistics facilities went through, which is higher clear heights, more truck bays, bigger, better, more robust to handle larger operations. And right now they're still in areas of the city where they have access to trucking infrastructure and rail and highways, but they're not really infringing on residential neighborhoods yet. But as happens with every new city and property type, NIMBYism collides with affordable housing, pretty common, and you're going to see this exacerbated by data centers and other building types that are swallowing up compute power. And not only that, energy infrastructure. You see a lot of cities whose energy bills are going up because they have to pay for the ongoing operations of these data centers.
Well, Kevin, thank you for taking time with me today, and wish you all the best in all your endeavors here in this beautiful commercial real estate universe.
Yeah, thanks for having me on. This is great.
We We hope you enjoyed this episode of the Purpose Driven Capital Podcast. If you found this valuable, be sure to like, subscribe, and share. Are you ready to align your money with your mission? Discover the Purpose-Driven Capital Framework, access practical tools, and build meaningful connections to grow your movement and multiply your impact at purposedrivencapital.co. The views and opinions expressed in this show are solely those of the individual speaking and do not reflect the views or opinions of Honey Hive Capital, any broker-dealer, investment advisory firm, or its sponsors. The content is for informational and entertainment purposes only. Nothing in this content, nor any communications from it, should be treated as constituting financial, investment, legal, tax, or other advice of any kind, or as a recommendation to buy or sell an interest with respect to any investment. We look forward to you joining us next time.